Welcome to this week's class. Our topic for this week is financial institutions. Last week we looked at the meaning of money, the types of money, the features, and the functions of money. So this week we'll be looking at where these monies are kept and how monies are created. When we talk about financial institution, it is simply an organization or an institution that deals primarily with money. It's divided into two. We have the banking institutions and the non-banking institutions. The banking institution is an institution, or they are institutions that accept deposits from members of the public and also give out loans to the members of the public. These members of the public serve as their customers, and they can be individuals, firms, or the government. What then is a bank? A bank is a place where valuables are kept. A bank is an institution that gives out loan to its members. It also receives deposits from members of the public. Now, before we delve properly into banking institution, I would like us to touch on the traditional financial institution. The traditional financial institution is a system of financial institution that mobilizes funds from the public. It was in use in time past, before the origination of banks. So usually members of the society, of the community, pool their resources together, their financial resources together, and at the end of the period, if any member had any need, probably there was need to use such funds. Probably a member had a burial ceremony or a wedding ceremony or anything came up, the monies were taken from the funds and then used to meet this member's needs. Now, it came in different forms. We have Esusu, we have Ajo. The Esusu is the one I just explained. Ajo, on the other hand, is when members of the community pool their resources together and then they get back this money rotationally at the end of each month. It is still in operation currently. Most income earners still undergo this traditional financial institution method. Now let's go back to our banking institutions. Banks are divided into different forms. We have different types of banks, but our focus this week will be on commercial banks and the central bank. What then is a commercial bank? A commercial bank is a bank that accepts deposits from customers, mobilizes funds from customers, and also gives out loans to these customers. It's a public limited liability company that is financed and managed by shareholders' monies. We have different types of banks in Nigeria. We have the Guaranty Trust Bank, the First Bank, Union Bank, and so on and so forth. Now, what are the functions of commercial banks? Number one, they accept and keep customers' deposits. These customer deposits can be in three forms. It can be through current accounts, savings accounts, and the fixed deposit accounts. Current accounts are majorly operated by firms, businessmen and women, as well as salary earners. Savings account, on the other hand, is put in place to encourage the members of the public to save their money. At the end of the period, they can always withdraw this money using their passbook or the ATM card. The fixed deposit account, on the other hand, is time bound. It is not withdrawable on demand. It has to be withdrawn at the end of the period that was stated. Remember, we are talking about the functions of commercial banks. Number two, commercial banks act as agents of payment on behalf of their customers. What this means is they help customers to pay out monies to stated individual. This takes the form of standing order. If, for example, I make a standing order to my bank to pay out 20,000 each month to my parents or to a named account, the bank will do that every month at the end or at the beginning of every month without me giving them a notification or a reminder. Number three, they give financial advice to their customers. Number four, commercial banks act as lending agents. They give out loans to members of the public, especially people who keep accounts or open accounts with them. Number 5, they help their customers to keep their valuables. So apart from money, commercial banks also keep valuables like will, like landed properties on documents that has to do with landed properties, and so on and so forth. Then finally, they contribute to the income of the government through the payment of tax. Now let's look at the ways through which commercial banks create credit. That's one of the main functions of the commercial bank. Commercial banks create credit by expanding their customers' deposit. What this means is you save money at the bank keeps back the minimum requirements or the liquidity ratio that's required by the central bank. They keep it at the central bank. Then the remaining of that money, they trade with it. They can either give it out as loan to other customer that needs it. So by receiving interest on this loan, they help to create further money or further credit. Apart from that, by also giving out overdrafts to their customers, they also help in creating credit or money. Overdraft is a situation where commercial banks allows its customers to withdraw over and above its current balance in the bank. Okay, at the end of the period, they pay interest on it. Another way is by buying treasury bills from the government at discounted rates. Now let's go to central banks. What is a central bank? A central bank is the apex bank of any country. It is a bank that is established by the federal government to regulate the activities of the financial activities within the country. There are many functions of a commercial bank. Number 1, it issues the currency of a country. Now, before I go to the functions, each country of the world has its own central bank. In Nigeria, it is called the Central Bank of Nigeria, CBN. In other parts of the world, they have different names they call it. Ghana may also call its own, probably the Central Bank of Ghana, whatever it is they call it. USA may call their own Federal Reserve Bank. So they have different names. Now the functions, it is the central banks that issues the currencies that are used within the country. The naira, as you have it, is minted and issued by the central bank. Number 2, they act as banker and advisor to the federal government. The federal government does not put money in the commercial bank like you and I do, but rather their own bank is the central bank. Number 3, it is a lender of last resort. So it is the central banks that gives out loan to commercial banks when commercial banks are in a fix or they need instant loan. Number 4, it is the banker's bank. It is mandated by law that all commercial banks within the country open an account with the central bank. Just like you and I open accounts with commercial banks, the commercial banks also keep accounts with the central bank. Number 5, it undertakes foreign financial obligation for a country. That means if a country needs to borrow money from outside the country, okay, it does that through the central bank. If it needs to borrow from the International Monetary Fund, IMF, or through the World Bank, it does that through the central bank. Number 6, it promotes economic growth by ensuring price stability and financing development projects. Now, there are different ways through which central banks exercise controls over the commercial bank, and there are weapons that they use. Now let's look at these ways. Number 1, the use of open market operation, OMO. This is the buying and selling of securities from and to commercial banks in order to either reduce or to increase the volume of money in circulation. If the federal government wants to either reduce or increase the volume of money in circulation, it does that through the central bank by ensuring that the central bank buys securities, either buys or sells security to the central bank. Okay. Number 2, to the commercial banks, I beg your pardon. Number 2, the use of bank rate. This is the interest that is charged by the central banks or the rates at which bills are discounted. So if the central bank decides to probably increase the rate at which is borrowing to the commercial banks, you should understand that there's a reason for that. Probably it needs to withdraw money from circulation. Probably that there's too much money in circulation, and in a bid to reduce it, it increases its own rate. If on the other hand, it needs to pump in more money, what it does is it will reduce its lending rate to the commercial bank. Number 3, cash or liquidity ratio. This is the amount of deposited fund that must be kept with the central bank in order to meet up with the customer's demand for money. Number 4, moral suasion. Moral suasion is when central bank appeal to the commercial bank, okay? Like they are begging them, please take up this monetary policy. Don't be too probably hard on borrowing, So it takes the form of appeal. It doesn't take direct instruction. The last one there is special instruction or directive. That one takes the form of force. When central bank gives out directives to the commercial bank, this is what we want you to do, and you have no choice than to do it. If, for example, the central bank wants to encourage farmers to, they want to encourage more people in the agricultural sector, they may tell the commercial banks, you know what, give more loans to the farmers. Okay, so it comes in form of special directive. Give more loans to the farmers and reduce the rate of interest you give to them. So class, we have come to the end of today's class. You have a class activity there. Attempt it and forward it back to me. Ibawa, I've not been seeing you. Oyinda Mola, I've never seen your assignment. Please attempt this and forward it back to me. So I'll see you next week. Just stay safe.